Jakes, welcome back. It's always a pleasure to have you back on the show.
Thank you.
Last time when we met, everybody was crying for correction. The correction has come in, and now suddenly everyone is getting cold feet.
Well, you know, the good thing about a bull market is when people cry for corrections. So the way I would kind of split this in two ways. The best part about this bull market is that there are more new lows than new highs, which means things are getting extremely sort of narrow in terms of its movement, and those who are looking at the index are not getting any salvation in terms of their portfolio, because their portfolio contains a whole bunch of other things. But I think the reality is that deep down a lot of changes have happened, which I think will make big getting bigger, wealthy getting wealthier, and the small getting marginalized, probably the theme going forward. Whether it is SEBI and the MCA going after the smaller companies and the sort of shell companies, or it's GST and demonetization effectively eliminating small and medium sector to a large measure, there is, I would say, a tectonic shift in the way we have to look at investments, the way we would look at the Nifty. And I am actually going to suggest that the way the Nifty is behaving in terms of, the grinding movement, slow buy on dips with cries for correction galore, is probably going to be the way the theme is going to work out, and the markets will remain optically overvalued for long periods of time, with corrections that people don't participate in, and when the move happens, people not getting sort of gratification in their portfolio. This is going to be the sort of unifying theme for the next several years, in my opinion.
So how does one judge that this is the right time to buy, this is not the right time to buy? If we are in a bull market, when should we plan our entry? Because the general chorus on the street has been that, look, the long term is great, but wait for a correction because valuations have run ahead of themselves.
Actually, that statement at one level means nothing, because it just means that long term is great, then you should not be timing the markets.
Exactly.
If you're trying to time the markets, you believe it's a trading market. And I don't think trading in general has made people money, and certainly not even in this bull market. The way I would look at it is, along with these two themes I mentioned of, in the organized space, the big guys getting bigger, and in the markets, the sort of big heavy caps or the index heavy stocks getting more prominent, is also the theme in the political side, where the opposition is getting even more fragmented than they were, even more marginalized than they were, and the big ruling party getting even bigger with whatever is happening in Bihar, etc. So I think for the first time the themes are converging. So perhaps passive investments, which is through the SIPs, allowing mutual fund managers to take big index heavy calls because they naturally drift and gravitate towards that, may well be the way to do it. So there is, at some points in time, the investment cycle, nothing, pardon the use of the word, nothing sexy about trying to discover stocks. So if you're not a professional and you can't go out there and deep dive and discover the undiscovered stocks, or you're unprepared to sort of traverse the road less traveled on, if you're any of these, that means you're unwilling to do any of these, what do you do? You end up just investing in the heavyweight stocks and saying. So in fact, our advice, even from a corporate finance perspective, to a lot of the friends that we have in the, who are individuals or running businesses, to say, assume for a moment that as you get older, there are greater uncertainties in terms of children's education, etc., etc. Why don't you pull money out of your own business? Invest through the markets in businesses that you want, with an exit which is one day and an exit load that's almost non-existent. So why would you not, with the benefit of 30, 40 years or 20 years being in running your own business? Today, people have invested 5, 7, 10 crores in the MSME space in individual businesses. Their exit is almost non-existent. Can you liquidate your plant and machinery? Are there buyers for that kind of stuff? Your money is locked up in inventory, your money is locked up in receivables, your money is locked up in all kinds of advance tax paid, tax refunds due. I mean, this is a nightmare. As opposed to which, if you could have invested in the 10 best businesses in India through the index and gone through good, bad and ugly periods, and these companies will continue. For instance, the auto space, maybe there are top 2, 3 majors, and go for the top down. If India sells X million cars and China sells 10 million, 10 times more or 6 times more cars, that will change. So the top 2, 3 car companies are not going to disappear, top 2, 3 auto, two-wheeler companies are not going to disappear. Take a portfolio approach, and I am telling you, you probably will have a far more peaceful 12, 14, 15% CAGR into the next 10 years, which your business, with all its attendant risk and the age profile changing, is not going to provide. I think it's a, I think it's a tectonic shift. At one level, investment never got more simple. But somehow people believe that they need to identify stocks. You don't need to. You need to identify the people who identify stocks, the mutual fund managers with tested track record and pedigree, etc. So if you go back and say, I feel we are a blessed generation. We who are in our mid-50s are a blessed generation because we started life where a single project in class took 6 months to do between conceptualizing, information gathering, etc. Today it can be done in 6 hours, right? Because everything is available. At the same time, we've gone through a technology shift where zero technology to everything on your pad and all your office virtually on your phone kind of thing. And now investment. And as we progress, I can see that with the benefit of hindsight, I would have liked to put up a fantastic two-wheeler business in India. I haven't done it, but no problem. There is somebody who's done it. I want to put up a great chemicals company. Somebody has done it. Petrochemicals, whatever. I'm just saying. So I think in some senses, investments is, making money through the market has just gotten simpler if you just subcontract it to the specialists. So the mutual funds are meant for this. And I can't overemphasize this point that actually speaking,
the returns have been great also.
And the return of capital, by the way, in your mid-50s is more important than the return on capital, which means if I invest somewhere, can I get my money back quickly, is more important than how much of the money am I getting back.
But Jix, your DNA is all about identifying new themes, small cap stocks, identifying the curve.
Yeah.
Now for, when a stock picker says, guys, just focus on large cap stocks and give your money to...
I'm saying that's true for the individual at large.
Okay.
Why are people who are putting money into SIPs not able to, see month-to-month gratification, but as all investment gurus will tell you, you will get gratification over a 15, 20, 25-year period. Yes, you may want to have a 10, 15% of your portfolio in money that you can blow up, which means you go down, do the deep dive. And I'll tell you one thing. In a market where the moment there is this sort of shell company news, as it were, and every mid-cap company goes through a correction, those corrections are significantly more than market corrections. So a mid-cap stock can correct 40% before you realize. And why? Because somebody is leveraged, somebody's got caught, etc. in a trade larger than his position afforded. From that perspective, you will get opportunities, but do people have the necessary wherewithal to do it? So I'm saying it's becoming far more difficult for me to communicate without telling people, this stock has gone up 6%, why did it go up? Went down 8%, why did it go down? It's impossible to answer those queries because today, given the amount of money there is in the system, the impact cost on smaller stocks has become much larger than the, when big pharma companies crack 6 and 8% in a day, what are small mid-cap companies? Where the pharma space, which is a darling 18 months ago, is today almost a pariah space as far as people are concerned.
Are you buying the fear in pharma?
I think, again, company specific. There are 1 or 2 pharma companies we intensely love for the kind of businesses they put up.
Are they part of the Nifty?
I don't want to talk to them because this may be sort of talking into stocks with disclosures, etc. But actually speaking, large pharma companies are facing huge challenges. There are 1 or 2 who are standing tall and it's there for everybody to see. So those companies, you have to be there. It's contrarian, they're also inexpensive. And in a market where forward P is maybe at 22, 23 times or 20 times, you will have these companies quoting mid-teens. Why would you not buy? 2, IT, much greater challenges than pharma to my mind, because you needed to productize yourself, you needed to be in different markets. I pricing is a huge issue, etc. But there are spaces, even in the restructuring space, for instance. How many people understand restructuring? So it's difficult out here to assume that you can come and talk 4 stocks that will sort of withstand, but you need to go through cycles with them to make money. Investment from a stock perspective is far, far, far more difficult today than ever before because information flows so much. But on the other hand, if you were to go for passive investment, I'm telling you, through compounding, you're getting significantly more returns than you ever got.
So go for index investing within passive investing.
I think 80-85% of your money should be index investing.
Okay.
Where, I would say for most people, I'm not saying that is for specialists who in our business who, whether out of our own intellectual arrogance or otherwise, will want to be in individual stocks. But 15-20%, of course you can be in mid-cap stocks, but you need to have the deep dive. But if you don't have the stomach to take a 30%, you cannot sit and say, I must get a 10-bagger.
Of course. But would you like to take a view on the index now, given that the earnings projections, we've started last 3 years with double-digit assumptions. By the end of the year, we scale them down to single-digit and the cycle starts again. And I get a sense that the similar cycle would be at play. January 2017 estimates were different. August 2017 estimates have been slashed down radically.
I mean, I tend to agree with you. It may go through a change of that kind. I think the way I see money moving in, and again through money coming out of gold, real estate, etc., which people have talked about, and the overseas investors haven't really bought into India in a very significant way in the last 2 years. So if that also turns, because today you're seeing political stability with economic stability, with macro stability, etc., for the first time, and interest rates coming down. I mean, when was the confluence of all these events happening? So you're not going to get a cheap market. So with money moving in all the time, looking for dips to come in, I think the index will, I mean, if it won't surprise me if in the next 5 years it grows 13-14% compounded every year.
Always believe in identifying inflection points, whether it's for the industry, sector, earnings or profits. What kind of inflection points do you think we could be staring at for next 2 to 3 years?
I think the big inflection point is in terms of events in the corporate space. One is the entire business about the NPA resolution. I think these are big inflection points for big companies to get even bigger, because now they'll be acquiring capacities at good competitive prices to add to their existing capacity. Steel is a big case in point. Power is another case in point. Textiles could be another space, which is crying for consolidation. On the other hand, along with this is the inflection in terms of money getting cheaper. So overseas money, pension money is hankering for returns. Any yields of any kind, they are going at 0.5% and 1% returns overseas. So when pension money comes into the restructuring space, assets are now available. Banks are able to solve their problems out. So capital is no longer a constraint for good companies to acquire. So I think the big inflection point was this, which is the resolution of these problems which is happening. That's one. The second big thing is the free flow of money into the debt markets. Those limits are opening up all the time. Yeah. Interest rates are likely to remain subdued for long periods of time. If you have that visibility, both in terms of debt markets and in terms of the impact on the equity markets, the yield expectations will also be much lower from an equity. You're going at debt yields which are 10-year yields of 6.3 or 6.5%. Why would you expect equity returns of 30%? You don't need to. So even at 10-12% compounded, people are going to get significant amounts of money. So I think the big inflection is this realization that index investment and money moving in, because I think there's a gravitational pull that will take money to the large caps in preference to the small caps, because you can put more money to work, you can put more money readily to work, etc., etc. And three, the entire thing about domestic savings now decisively moving into this space. I think these are big inflection points in favor of, I would say, A, passive investment, and B, much longer term investment. So I think whether it's retirement planning, whether it's this entire thing about mutual fund days being celebrated, every month with SIPs, ruling the roost, I think these are tectonic shifts in the backdrop of stable politics and stable macroeconomic factors. So I think the condition couldn't be better. So from that perspective, whether the Nifty corrects from 10,200 to 9,800 or 9,600 doesn't matter. But for the stock specific guy, any 8-10% correction in the market becomes a great opportunity to identify those B group stocks where you have the stomach for your 10-15% of the portfolio. That's
so 85% you made it easy.
Yeah.
Stick to passive investing. Don't look at the Nifty. Have a 5 to 10 year view.
For most viewers, that should be the way I would say going forward.
What about the 15%?
The 15% I think could be a combination of PMS schemes which focus on the mid caps, or it could be small and sort of mid cap funds of established fund houses.
Okay.
So there are 2-3 fund houses whose mid cap funds who've done extremely well. I mean, the portfolios are there for people to see, and I think they are in the job of hunting or PMS managers who are more nimble than mutual fund guys who may have their own constraints. I think that's the way forward.
Now, last time you referred to a theme which is that bet on companies which have a high debt and which are really in the process of restructuring.
And there was a good reason for that. The reason debt rates were coming down, resolutions were happening, you can settle debts. So as long as the forensic audit of your company didn't reveal any wrongdoing, you could actually restructure your portfolio, go back to banks and say, I can't operate at 1500 crores, for instance, I'm now going to operate at 800 crores. If there is no other viable option, the bank gives it to you, gives it back to you. You run at a lower amount of debt. You got, in a sense, you've done a Ganga Snan midstream. You've come clean. The NCLT is a faster, easier resolution, more transparent, with a court ka thappa, which allows banks to also say, fine, we've gone through a process. The IRP or the resolution professional has actually, done his auctions or whatever, and he's come to the thing that this 800 is a sustainable debt, based on which you continue your business, you bring in some equity. So, in a sense, the ability to do mid-course correction for over-levered companies was very much there. So, over-levered companies, if you knock off 40-50% of the debt, the equity value it throws out is disproportionate, because most of these guys started by saying debt was, let us say, 1000 crores, market cap was 100 crores or 50 crores, and when you knock off 500 crores of debt, any amount of equity addition to the equity value would give you a 2-bagger or a 3-bagger. And there are many, many cases. I mean, I don't want to go through one or two, but any number of cases. Yes, some of them were completely bankrupt cases where even after debt reduction, they were not sustainable. They will sort of go under liquidation. But the NCLT allowed, and when we did this, if you remember, we talked about a resolution mechanism coming through 6 months ago, and that has been announced. Now the resolution, whether through the banks or through the NCLT or a combination, is there for everybody to see. As long as that resolution can happen, many of these levered companies will throw up returns which are disproportionate. And I say disproportionate because the average person on the street only looks at the share price to take a call. Whereas if you dived deep, you could actually see how much you could gain from some of these. And there are 1 or 2 cases which you will see soon, which will give disproportionate returns.
So the kind of price action what we've seen in JP Associates, because they got the act right and they finally admitted that, look, we messed up in the last cycle, but now let's look forward. We want to clean up our balance sheet. Could that be a factor which could be at play with other companies as well? Do you think there's a genuine attempt by corporate India now?
I don't know if I want to comment on JP specifically. I mean, but in general, what happens is markets, when they fear bankruptcy, drive down stock prices to dust levels, where the stock price then becomes an optionality of the future. Think tum leke chale jao, it's an option. If it works, it works. On the other hand, the template that JP has put together is clear, that we have to sell assets. We have to show that we are willing to part, which an industrialist in the past for 50, 70 years never parted with assets. Now he is willing to say, I'm willing to part with assets, my land bank, my cement assets, etc. And the residual is a company that, does have a chance for survival. I think there is no question that the template is what people will follow, but whether the price action, etc., depends on specifics. And that's why restructuring can't be painted with the same brush across the length and breadth of corporate India. It has to be seen in the context of specific companies, specific financials, specific, and please understand, I think when corporates are negotiating with banks also over a period of time have got tired holding on to this. So are now more readily willing to settle. And they've got a mechanism called the NCLT which allows them to settle. In the past, there was the fear that you settle with somebody and then CBI would be after you. So today that, should I say, the spectre of that also has disappeared. So I think there is just a lot of a lot of stuff to be looked at. And the biggest opportunity is India has got 8,000 listed companies. So for people who want to go into individual stocks, there is the option. But I keep going down that thing, given everything, it is becoming very much more difficult to identify your sort of poison. So keep it to 10-15%. And then again, it's a function of age, as you there's this old phrase about, we are fully in investment banking today, and we say investment bankers don't die, they only yield to maturity. So it's the YTM concept, right? So we kind of need to change with the time. So I think that's the remodeling that we've done with our business, which is advisory driven, no use of capital. And to that extent, I'm also in a sense, therefore, advising viewers to see it the same way, that you don't try to be masters of the universe with 8,000 companies. Nobody can. And so if Rahul Bajaj, for instance, or Rajiv Bajaj, the person you've chosen to back him, there's enough in public domain to figure out what he does, what he doesn't do. and move on with that, or a hero, or whatever else that you may choose in that particular space. So the idea is to back people who've done the thing, which in a sense substitutes for your efforts at doing the same investment in that field.
So I'm sure if this show was live, a viewer would have tweeted me saying that we want to bet on N Jayakumar. How should we bet on him?
I mean, I'm more conflicted on this answer than ever before. But I'll tell you, the only thing I can say is I go back to this Warren Buffett thing, which at the age of 53 was $1 billion in net worth. At the age of 85, he's 65 billion.
So you have a long way to go.
70 billion. No, so the way the takeaway for me is, and Warren Buffett actually said that he eliminated a lot of the mistakes. वो जवानी की भूल जो होती है वो तुमने अगर उसका सुधार किया तो then you can move on. So all of us have made mistakes, and I don't ever fight shy of that. And we're all human at the end of the day. But if we can learn from the past and eliminate the volatilities of our mistakes of the past, maybe staying more focused on one's strengths than to dissipate one's energy, then betting on A or B is a decision somebody else will take. But I think that's the way people reshape. And hopefully, given the fact that work itself is what most people aspire to do for as long as you are up and about, then I think taking from Warren Buffett as an example, that his best returns have come between 53 and 85. That means the mistakes of pre-50 or pre-40 have been eliminated. And if you take the sine curve, for instance, upar niche, if the bottom part can be eliminated or reduced significantly, the compounding of the top can be pretty dramatic.
You don't have to get everything right. You just have to prevent some mistakes, and that's how
the other way
compounding goes. Okay. 5 years ago, HDFC Bank was a great buy. 10 years ago, also HDFC Bank was a great buy. 10 years henceforth, also HDFC Bank would be a great buy. Which are some of the entrepreneurs, promoters, or businesses you would say they are evergreen in nature, and you're happy to just buy them and go to Himalaya for a 10-year holiday?
I still think that sometimes it's what I call the intellectual arrogance that prevents us from saying continue backing, for instance, an HDFC Bank, or continue backing a Bajaj Auto, notwithstanding the ups and downs, or continue backing some of these big, well-known. I mean, Hindustan Lever has only gotten more expensive. So if you look back and say, had I done a passive investment 15, 18 years ago, the question is, what would I have done at the time other than
exactly.
So life is not about just maximizing that. I think that's what the truth of the rationalization we have. That if I had X amount of money in 95, why did I, for instance, try to pick out a startup in the IPTV space? Why did I, for instance, try picking up a startup in the shipyard space, etc., etc., rather than just backing the. And I think the benefit of hindsight tells you that you don't need to do the complicated things in life to achieve some of your ends. You could do the simple things, but with the humility that there are better people than you in those businesses. So some of the businesses mentioned by you are evergreen, I think, and they sometimes become so large that as long as individual personalities don't become so dominant, the institution just continues, then natural growth is your compounder.
Fair point.
Natural growth. And I think it is the arrogance, so notwithstanding the 10 and 20 baggers that we may have got in our portfolio, and maybe at the end of the day they give you more satisfaction than saying I bought an HDFC Bank. But the realization is that the HDFC Bank has done as well as any this thing. So I think I'm glad you've raised it, but it's a very humbling point that you don't need to do the complicated things in life to achieve your life's goals. You do simple things and do them right.
And the simple process for an average investor who's watching the show is that go for index investing. The charge is less.
And more importantly, the people managing indices today, the mutual fund, are good guys. They are the mutual fund managers are some of the best we have anywhere in the world, I would say. Maybe they don't have the experience that some of the other guys, but they don't even, they stay with on the beaten path, as it were. They're doing a good job. 80-85% is naturally gravitated there. So if there's a 10-15% somewhere else, you can have your, your excitement elsewhere. But there's no harm, especially the way India is evolving, especially the way through GST demonetization, the underbelly of the economy is evolving. I think there is no substitute but to put money in the manner suggested.
Okay. Jakes, really appreciate your time. Glad you could join us on this edition of Market Makers. And that's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.